The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello, welcome to a brand new year, and welcome also, finally, to my special broadcast of Property Investing Matters, where for the next half an hour or so, I'll be dedicating the entire show to answering your questions. It's also our first episode for 2023, and I'm happy to be back bringing great property education to you once again. Now, as you know, I do get a lot of questions, and many of them are ones that would be appropriate for many types of property investors. So I thought it would be a great idea for me to spend an entire show answering some of them. Let's start with that first question, and it comes from Bruno about work from home. And Bruno asks, "Hi Margaret, has work from home added another question to the 20 must-ask questions to analyse? Is it important to know if there are more people who are working from home in a specific area compared to another area that has less?" And that question comes from Bruno. Well, Bruno, this new trend to work from home doesn't add a new question, but it does expand on one which we already ask, and that is, what are the demographics of the area? It's more important than ever before that we understand who is going to be living in our property. Now, where your property is purchased in a blue-collar worker area, where many of the residents work in physical jobs, then they're not going to be looking for specific features to enhance their potential to work from home. But where your purchase is in an area where your potential tenants are more likely to hold office-based jobs, and it's also an area where evidence shows that there's a significant commute to work for those people, then it could be a good idea to consider two things. Firstly, the potential for the property you buy to provide suitable work from home space, and secondly, choosing a property in an area with NBN internet. Do be aware, though, that the trend toward working from home is already waning, and this may not be a long-term need. I wouldn't be paying any extra to get such a space, but it is certainly worth considering before you go ahead and purchase a property. Now, this next question is from Chris, and it's about commercial property. And Chris asks, "Hi Margaret, I know on the show you mainly discuss resi properties, but I was wondering if you could provide some insight into the following question pertaining to commercial properties by any chance. If a tenant leaves or wants to leave after 2 years, for example, but is in a 5+5 year lease, what recourse do you have to recoup the remaining 3 years' rent, as opposed to going through the process of getting another tenant, and is it different to residential property?" I've often spoken about commercial property and pointed out that while the returns can indeed be significantly better than residential property, the risk is much greater. One of those risks is vacancy, with commercial property tending toward having longer periods of vacancy and being more prone to that vacancy as the economy bounces about. But even when you have a longer-term tenant, there's no guarantee that they'll be able to see out their lease period. The stats around the number of smaller businesses which go broke in Australia every year is quite shocking, and as a smaller investor, it's likely that the commercial premises that you buy will be one which attracts that small business. Therefore, expecting that a tenant will see out a 5-year lease is something that you just can't do. You don't really have any recourse if that business has gone broke, as you'll just line up behind everyone else as a creditor, and there will be more significant creditors such as lenders and possibly customers in front of you. You can, however, do a few things at the buying stage. For example, Ensure that what you buy has many uses, not just one. So, a shop may be limiting, but a blank commercial space in a business park might have more applications and therefore be less prone to vacancy if particular industries are impacted by an economic downturn. Next, ensure that your tenant provides a bank guarantee. Still not really a guarantee, but at least a sign that the bank has confidence in the financial health of that business. Look for tenants who may be able to pay by the quarter or 6 monthly so that they're well paid ahead. And don't allow the tenant to fit out your property in a way that's not attractive to many tenant types, because this might limit your capacity to get a new tenant if they do happen to break their lease. You can, of course, take them to court to recover any unpaid rent, but this is costly, time-consuming, and usually results in no positive outcome for the landlord. Do your research going in and be sure that you buy, or what you buy, is a property that would have a wide demand, and a tenant breaking a lease may not have as much impact on you. Next, we have a question about property development costs, and it comes from Ryan. Hi, Margaret. My question regarding property development is surrounding the architectural drawings. Is there a specific number that you use in your feasibility study regarding architectural drawings? My findings have been that they range greatly, and wondered if you had a percentage of total in value or a dollar per square metre rate that you would use for making allowances for this aspect. Ryan, one of the things about property development is that the costs to develop not only vary from state to state, they can also vary from area to area. In my recent property development book, you'll read that I found the engineering costs between New South Wales and SA were vastly different for similar work. I also found that the costs of architectural drawings vary greatly too, much cheaper in South Australia than they were in New South Wales, even in country New South Wales. That's why I'd not use a percentage per square metre. It's really important that you understand that a feasibility study, just because it's done well prior to proceeding with the development, isn't a table of guesswork figures. While things can and do change from the feasibility stage, it's really important to get it as close to reality as you possibly can. Now, you do this by calling around and getting actual rates from real professionals and then using an average of those rates. You should do this for every entry in your feasibility. Feasibility studies do take a lot of time, and there is no excuse for skimping on this time or any excuse for taking any shortcuts. The next question is about solar panels. Hi, Margaret. I have a few investment properties. If I place solar panels on one of my investment properties, I would be able to claim depreciation on the panels. However, am I able to claim any rebates on any tariff reduction that would be available to me by way of feeding the excess power into the grid? This is a pretty interesting question, and it's also one that I haven't really been asked before. Solar panels and any rebates they may or may not provide to you is relatively new, and I couldn't find a test case on it. But if we provide the logic of the tax office to this, we can probably work out where they'd stand on it. This is how I see it. As you suggest, you could depreciate the cost of supplying these panels, which will add cash flows. The benefit of the panel really sits with the tenant, who should then receive reduced energy costs. As an energy cost is paid by the tenant, the rebate will be gained by them. It's not yours to claim in any way. If you instead met all the energy costs as part of the deal and the connection was in your name, you then would own the rebate. But it will only stand as a deduction against your expenses, and it would reduce, not increase, your deductions. The only way that I can see a benefit to you here would be for you to cover energy costs and charge an increased rent for the all-inclusive tenancy. It might be difficult to determine just how much more to charge, and it may turn potential tenants away. In any event, you will still get the improved depreciation benefits, plus the potential to add value for this enhancement to the property. Now, I get a lot of questions about schemes and scams, and here's one of them. Hi, Margaret. I went to a seminar where the presenter advised people that they could build a portfolio of properties and then live off equity, getting as a passive income via a line of credit. How much equity is required to be able to have $75,000 per year in this way, and what do you think of the idea? And that's from Gerben. Well, Gerben, I've seen this strategy too, and quite frankly, it really worries me. Years ago, when property was growing really well, and even in the last couple of years where we've seen a boom, where it boomed no matter where you purchased, people found that every year they had an increase to the value, which meant that as they used the funds in the line of credit, they could just keep going back to increase the loan as the value increased. Even under the circumstances of a strong property market, I don't like the idea, and here are all my reasons for that. If you keep using the equity by borrowing against it to make an income to live on, you'll never have any equity left over. This means that you can't add more property due to growth, but it also means that when you reach retirement, you'll have no equity or net worth. Net worth is a really important factor in a financially sound retirement, and you want this to grow, not be reduced by borrowing against it. In years where the property doesn't grow, what will you do for income? You won't be allowed to increase the loan to provide one. When you do retire, how will you keep borrowing? The bank won't lend to you unless you have an income. And if you keep borrowing against the growing equity, you'll have little equity either to use for borrowing. In years where property stagnates, or, as has been the case in some properties just over the last few months, goes backward, you'll have some real trouble and get very behind as well. Gerben, the other problem is that you also have to meet the interest bill on the loans, and since the loan grows, so does that interest bill, and it's growing faster at the moment due to increasing interest rates. You're likely to find yourself with few funds available to meet this interest, let alone enough to also derive an income. To get a net $75,000 a year, you'd need your equity to grow at around $100,000 a year every single year. Now, to get that, you'd need $1 million in property, and it would need to grow by 10% every year. It's a far better strategy to build up your property over time and then pay down debt while you do this. Net equity gained in that way can then grow every year too, and you won't be as reliant on a set rate of growth. I'd say stay away from these highly risky strategies and stick to more simple ideas. This next question highlights the importance of looking ahead when you decide whose name to buy property in. Hi, Margaret. My partner and I have 2 mortgages. We have recently had a baby, and I'm continuing working while she stays at home. The rental property is in her name, and the one we live in is in my name. We've thought that it's probably a good idea to put the rental property in my name for tax purposes. Is this possible? What are the implications involved, if any? Are there any other options available for us? Thanks for your time. Well, Brad, when we claim tax deductions on a rental property, the proportion in which we can make the claims depends upon whose name is on the title. And typically, when we have a partner, we might split this 50-50, and sometimes the higher income earner of the two will take full ownership to maximise the deductions. The problem comes if things change, as has happened to you. Brad, some things for you to know are this property. As this property is in your partner's name, all tax deductions remain with her, and all the income is also attributed to her, so the tax deductions might still be useful. This fact may be now set in concrete depending upon where you live. In some states, you can make a transfer by way of love and affection, and this can be done for a small cost, usually related to drawing up paperwork to make that transfer. This is allowed between spouses or family members. In other states, no such option exists, and the only way to make the transfer is for you to effectively buy the property from your spouse. No money has to change hands, but stamp duty on the full market value of the property must be paid. Brad's current issue points out the importance of being a little more long-sighted and getting it right ahead of time. It may seem obvious to put the property in the higher income earner's name, but if there's potentially a change coming up in the future, then this won't work out so well. Always check with your accountant and have them work out the best long-term option for you, and do this before any contracts for any purchase are signed. I'm off for a quick break, but when Property Investing Matters returns, I'll get to the remaining questions, so don't go anywhere. I know you'd love to buy an investment property, but finding the time to do it the right way is almost impossible. That's why we created Property Match. Born from 25 years of Australia-wide investing experience, Property Match uses multiple data points and machine learning to match you with the property most suited to your circumstances. Get back to what you want to do with your spare time and let your next investment property find you. Head to mypropertymatch.com.au to find out more. Welcome back to Property Investing Matters, free and on demand on My Property TV. I'm Margaret Lomas, and tonight I'm answering all of your questions in a special Ask Margaret segment. Let's get to the next question now, and it's from Amanda. And Amanda says, I'm looking into tools to assist with my research. I've come across a number of companies offering data designed to help me buy property. I'm keen to get your views on these tools. Are they worth the money, and is the data set reliable? Are there any other tools that you'd recommend? Amanda, your first job is to establish what kind of data is being given and the position of the company giving it. I've seen companies who are basically selling property provide some interesting reports which paint the areas that they have in their stock as being amazing, and I'd suggest that this is not only a conflict, but that the data is unlikely to be reliable. When looking at any data, here are some guidelines that you should follow. Data relating to past growth figures won't provide you with details about what's happening tomorrow. Past growth figures aren't a reliable indicator of future growth. If anything, sometimes this data can assist you to identify an area that has had its boom and one where it may be too late to buy. Average and or median data is misleading as it takes into account all properties in all price ranges. High-end properties falling might mask any increases in low-end properties. Data should be treated as a small tool, but should never replace comprehensive due diligence, which takes into account microeconomic data about the actual town or suburb that you want to buy into. The best thing you can do for yourself is to enrol in a good property education course so that you don't need to rely on any data except the data you'll find for yourself when doing a comprehensive analysis of the area. This way you take responsibility for the success of your own investment. Next, to a question about granny flats and tax. And Jane asks, we own a 5-acre property near Darwin with a 4-bedroom house under renovation. My hubby is a 65-year-old self-employed tradesman, and as we are not overly endowed with super, he had the idea that if we built a small residence, a granny flat, on the same block with separate power, water, etc., we could base ourselves there and rent out the main dwelling for income. We would also caretake the block, mow the lawns, remove palm fronds, etc. can you please advise if our idea is even feasible tax-wise before we look into it further? Jane, this is an interesting question and one which is not often asked, and so I referred to Julia Hartman, a great tax expert on these more obscure scenarios. She said that there are many things that you need to consider, the main one being the capital gains tax exemption for your principal place of residence. Once the granny flat is built, if you moved into it immediately, then from a tax point of view, this would be treated as two separate properties. Once you rent out the former family home, the cost base of that property is considered to be the market value at the time. The granny flat and the land underneath it would also be given a market value. Now at this point, you'd have to choose which one you wanted covered by your main residence capital gains tax exemption, and ahead of time it can be really hard to work out which of the two is likely to have the greatest amount of growth. If you choose the former family home to have the exemption, then the granny flat and its land will have capital gains tax from its determined market value. If you choose the granny flat, then the family home will attract capital gains tax from the market value established upon when you moved out. Now, if you don't want the property to be treated like two separate assets, then you need to live in both the granny flat and the house combined as your home for the first 3 months at least. This way, the two houses are seen as one dwelling, and for capital gains tax purposes, the treatment would be just the same as if you were renting out rooms or part of your home. This, of course, exposes the whole property to capital gains tax from the market value of the whole property at the time the granny flat's built, but only for the portion of the home which is rented out. And so it is done on a pro rata basis. Now, as you can see, it's very complex. It's going to be really hard to actually work out which pathway is the best one to take, since you can't really estimate future values. Make sure that you have an accountant who can help you work out some ballpark figures, and don't make any decisions at all until you have a clear understanding of what could potentially happen in the future. Let's go now to question 9. What should you do to a property just before you rent it out? And Chris says, I bought a new property and the agent has told me that I should do some things to it before I rent it out. There were tenants in it when I bought it, so I'm not sure that it needs any work done. How do I know how much to spend on the property in order to get the best returns? Well, thanks for your question, Chris. I often have property managers suggesting all manner of enhancements, and it can be hard to know what really needs to be done. My advice to you is the following. First of all, have your chosen property manager go out and take a look at the property and let you know if it's already fit to rent out. Ask them to take pictures of the things that they suggest need fixing or changing. Leaving off the nice to haves, cost out the rest and establish what the interest on a loan of that size would be. Ask the property manager to quote you a new potential rent if these things were done. Now, if the new rent exceeds the additional interest costs on any borrowings you need to make to do these things, then it might be worth it. Chris, an important thing to note is that some renovations will definitely add saleability to a property, but you're not selling right now, and these things might not be necessary in a rental. This includes a lot of aesthetic things which most rentals don't need, like fancy carpets and fittings. I'd limit my spending on a rental to the absolute minimum until the time came where I was thinking of selling, or until work really needed to be carried out, to ensure that you can get an ongoing tenancy. The next question is a quick one from Mark about interest rates. And he asks, hi Margaret, would you expect interest rates to decrease once again once inflation is under control, or do you think they'll remain at around the current level? Mark, I expect that we might start seeing rates stabilise and even potentially a rate cut or two somewhere around the middle of this year. We're already seeing a deceleration of inflation coming out of the US, and even here in Australia we're likely to see the rate rises begin to impact early this year. As far as I can see, we have two issues. The first one is that many people are still in fixed rates, and so they aren't yet feeling the rate hike. This should end in the first few months of this year. But also, we have an unprecedented number of young people who don't even have a mortgage and they don't care about ever having one. And this sector of the population are also the spenders. And so interest rate hikes have zero impact on their spending habits. Once we get more people impacted by the rate rises, which will be, as I said, once most of the fixed rates end, we should see a moderating of inflation and a return to stable rates, and that might be the time that we might see those interest rate cuts kick in. I get a lot of questions about loans, and here is one of them. Hi Margaret, I'm currently looking at applying for finance for our first home, which will revert to an investment property in 1 to 2 years. Are there any tips on types of loan products, structures which I should look at, which will facilitate leveraging into more property in the future? And that is from Wayne. Wayne, I'm glad you asked about this before you went ahead and bought, as you can go about this the wrong way and you can't change it once you've done it. When we own property, we should be aiming to pay off the debt as quickly as we possibly can. When you gain equity in a property through debt repayment and also through value growth, you're essentially improving your net worth and creating an asset base that you can use to leverage into more investing. If you know that you only have a short period of time until you turn an owner-occupied property into an investment, you still want to get some equity, but you don't want to repay the debt because a fully drawn loan has greater tax advantages. Here's what I think you should do. Firstly, obtain the lowest rate loan possible, even one without too many features. Next, make sure that the loan you get has the option to add an interest offset account. Now, pay the minimum on the loan, interest-only payments if you can get them. Take every extra cent that you have and save it into the offset account. This way, you offset interest on the portion which you're saving. Essentially, whatever you save reduces the loan debt by the same amount, and you only pay interest on the rest. You still preserve the fully drawn loan. When you move out and buy again, what you've saved can become a deposit on the next owner-occupied property, and the debt on the property you move from is still a fully drawn debt. Wayne, you need to have a qualified property investment advisor show you how this works and also help you to establish how to use these savings in the best way for your next property. A little bit of planning now can make all the difference in the future. Our last question of the evening is about what happens to property once you've passed away. Hi Margaret, when preparing to leave a property to someone as part of an inheritance, what steps do you need to take to make it as simple as possible for the recipient, as well as ensuring tax effectiveness? Thank you and have a good day. Andrew, I'm not a lawyer, and this is a question that does need to be answered by a lawyer, or at least you should get some advice from your accountant. If the property's already been purchased and it's in your name, the assets will pass to either any other joint tenants who are also on the title, or if there are none, to your beneficiaries. If there is a joint tenant, then the property is dealt with outside of your estate and it passes directly to them, and they have the entire tax obligation if the property gets sold. So the tax obligation passes with the property. If there's no other joint tenant, then the property is considered as part of your estate and is dealt with via the will. Your beneficiaries inherit whatever tax obligation you had. So, as an investment property, there'll be capital gains tax if they sell, with the cost base being your cost base, and if it's an owner-occupied property, they get 2 years to sell it with no capital gains tax if they choose not to live in it to make it their own principal place of residence. Some people buy property in trust to make the passing of properties easier, but it doesn't really deal with the tax consequences, as there will be some, regardless of the structure holding the property. A trust at least allows the beneficiaries time to realise that obligation and gives them time to work out what they want to do with their inheritance and the best way to manage the tax consequences. If you hold property already and it's not in a trust, there's a simple solution. You can set up a testamentary trust, which costs nothing initially and is merely a trust created by your death. Your assets pass into this trust, and then it acts like any other trust, giving beneficiaries time and space to work out the best way to deal with the trust asset allocation. All you need to do is specify in your will that you wish for the trust to be created when you die. Again, though I'm neither a lawyer nor an accountant, I do urge everyone who owns a property in any form to have frank discussions with their accountant and lawyer to work out what works best for them. Well, that was a lot of great questions, and I hope you enjoyed this special episode. I plan to do an Ask Margaret special every few months, so be sure to get those questions to me and I can save them for that show. If I did answer your question tonight, you're the lucky recipient of one of my books. But to get it, you need to send an email to pam@mypropertytv.com.au with the subject book prize. Tell me your name, address, and which question you asked, and which book you would also like. Here are all my contact details if you have any questions, and if you'd like some guidance on where you should next be buying property, as well as getting my experienced team to locate the right property and help you to buy it. Our fab new service property match is just for you. Allow us to do all the work for you in hunting down that next hot spot. Go to mypropertymatch.com.au and give us a call. And that's all I have for you in this first episode of 2023. I hope you all had a fabulous break and a wonderful Christmas. And of course, we had all of those technical issues and couldn't get this show to you then. But here we are starting the brand new service, the brand new show for you this year. And I'm looking forward to having some great guests on. Don't forget, we can help you if you'd like to buy property with the minimum of stress. I have a fabulous team who can help you out. Have a great start to the new year, and I will see you next time here on Property Investing Matters. Hello there, I'm Margaret Lomas. You might remember me from my Sky News Business Property Show days. My company is Destiny, and we've taken the 25 years experience that we have in property advising and created Property Match. For the first time anywhere, now you can be matched with the investment property most suited to you. Give us a call today or visit the website mypropertymatch.com.au. Why not leave it to the people who know property investing the best? Destiny.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 20